Paul Tudor Jones, billionaire hedge fund manager Paul Tudor Jones, is getting very cautious. He's getting cautious about Bitcoin. He would not necessarily buy Bitcoin at this price, even though he does have a small allocation. And the reason for this is that he sees the main story of Bitcoin being an inflation hedge. And at the same time, he believes that AI advancements will increase productivity to a degree that inflation might come down. Right? Inflation is a consequence of how much output there is relative to the demand, and the output might increase with AI. But let's have a look at this together.
Bitcoin. You came on our air during the early part of the pandemic. I think it was trading at $8,000-$9,000 a coin. And you said, I'm in. And I think you rode it all the way up to 60 some odd $1,000. And we then rode it back down to $15,000, and we're now sitting, I think, somewhere around $27,000.
I've never sat on a horse that long, just so you know.
So what's you're still on the horse, though?
From the beginning, I've always said I want to have a small allocation to it because it's a great tail event. It's the only thing that humans can adjust the supply in. So I'm sticking with it. I'm going to always stick with it as just a small diversification in my portfolio. What do I think right now? I liked it last December. I still think I mean...
Would you buy more right now?
Would I buy more? I would probably... I look at it in gold, and I think they've done so well recently because of the fact that we have had these great risk premiums. I wonder whether they may not be boring in the future.
Right.
Also, Bitcoin has a real problem because in the United States you have the entire regulatory apparatus against it. So it's just kind of yesterday's news. And if inflation's truly done a bit, if that story's been played, then you have to wonder. We were buying gold and Bitcoin for the inflation hedges. That game may be over. I would, in 6 months ago, before AI, before the possible productivity boost that we'll get for it, I would have said a completely different story with regard to the inflationary future and with regard to all the inflation hedges.
Now let's talk about some of the inaccuracies that Paul Tudor Jones presented in that interview. Bitcoin is probably not the focus of his attention, and so he's not keeping up with everything that's being discussed in the space. So let's talk about a few of those points. The first one being Bitcoin can never be adjusted by humans. It only has this 21 million of maximum supply, and we see this halving every 4 years, right? The new supply that hits the market gets cut in half every year. That's the unique selling point of Bitcoin. Besides, of course, its decentralization, that there's no central authority that can crack it down. But here's the thing. There is actually a discussion for Bitcoin tail emissions. So feel free to look this up. The Bitcoin tail emissions debate, which talks about the healthiness of the miners. So when every 4 years the new Bitcoin gets cut in half, that gets sent to the miners, then the miners have a harder and harder time to work profitably as time goes on. So in other words, there is less and less computational power that protects Bitcoin. So the Bitcoin price has to rise at least double every 4 years in order to make up for the reduced emission. And so that's why there is this debate. Maybe we should have some change to the tokenomics at some point. Maybe we should allow for more than 21 million. It is a dangerous debate. I don't agree with increasing the supply. I'd rather think of new concepts, maybe increasing the transaction costs in a certain way, or maybe blocking even Bitcoin that hasn't moved for, say, more than 10 years, right? Tell every Bitcoiner they have to move their coins at least once every 10 years to make sure that they still keep the ownership. Maybe revive the lost coins. But breaking with this fundamental idea that there's never going to be more than 21 million Bitcoins, breaking with that idea is likely going to push away a lot of long-term holders. So I don't like it, but it's not safe that there will really never be more than 21 million Bitcoin. There is the debate going on. Now let's talk about another point, the regulatory apparatus being against Bitcoin. I'm not so sure anymore if that's really the case. There are of course the lawsuits by the SEC against crypto trading firms, against brokers. There are also lawsuits against particular crypto projects. But there has been the statement that Bitcoin is a commodity, it's not a security. And now we see a lot of traditional finance giants getting into Bitcoin, issuing Bitcoin ETFs. So especially for Bitcoin, I don't really see the pushback by regulation. So again, here I have to disagree with Paul Tudor Jones. Now, what about this inflation hedge idea? So the thesis is that Bitcoin simply just went up recently because it's an inflation hedge. There can't be more than 21 million Bitcoin. Now that the inflation tends to come back down again, maybe Bitcoin becomes less attractive. And this is where a lot of people can't really wrap their heads around this. Bitcoin isn't really highly correlated to anything that we've seen in the past. It's not highly correlated to the expectation on inflation. It's not highly correlated to the interest rates. It's not highly correlated to the tech stocks. It pretty much moves by itself. Similar to gold, by the way. It's pretty independent. It's a pretty good portfolio diversifier. So when the inflation story dies down, the tech leverage story might grow up again. It might become fashionable again. In other words, when stocks are going up, when Alphabet is going up, when Facebook is going up, and Bitcoin goes up in tandem, people just say, oh yeah, Bitcoin is simply just the more risky of the tech stocks. When the tech stocks are going down, but Bitcoin is going up, then it's suddenly the inflation hedge story. Really, Bitcoin lives on its own cycles, and that's because of the long-term holder dynamics. You can pretty much wait out any bear market, and that's what we see with long-term holders. They don't sell until Bitcoin hits new all-time highs. You can wait those bear markets out because there is not a lot of new Bitcoin being printed, and there are a lot of people that simply just do dollar cost average into Bitcoin every month. But when there's a crash, simply just buy, simply just hold, wait for a new bubble to form, wait for the media attention to kick in again, and then sell off gradually. And that kind of a dynamic we don't necessarily see in the stock market or in the gold market. The stock market is influenced by macroeconomic factors. The gold market is influenced by mining, by demographics, by inflation fears. But the Bitcoin market really has pretty much its own cycles. There are slight impacts from the traditional markets, but overall, if we measure the correlation coefficients against the S&P 500, against gold, against maybe the volatility index, it's not very high. It's at 0.6, 0.66. It is positive, but it's not very high. So yeah, I think Paul Tudor Jones gets the general story of Bitcoin, but it does lack some nuance, which is totally understandable, right? It's not the main focus of his investment strategy. If you've got Telegram, feel free to join us at Bitcoin Strategy channel. I chat there regularly. We discuss the current news over there, but also opportunities and potential signals when to get in and out of the market. Looking forward to chat with you in Telegram, and thanks for watching. Bye bye.